guys, welcome back to the channel. Everyone is watching earnings and they look at certain numbers, but nobody tracks these certain numbers. And I want to break it down today. Most investors are only looking at revenue beats, EPS beats, or guidance. And that's why they miss the real story underneath the hood. Today, I'm going to show you the most important numbers to really look at in the earnings report, and it's not what you think. I'll break down 5 important metrics you should track and watch. And by the end of this video, you'll know exactly what to look for in your next earnings report. Let's dive right into it. So first, I want to break down why the headline numbers are misleading. When companies report earnings, the media focuses on 1, revenue beat, 2, earnings per share beat, and 3, next quarter guidance. These are really surface level metrics to look at. They don't tell you about the business itself, if it is strengthening or weakening. What you actually want are the metrics that reveal the company's health. These are usually hidden inside the 10Q, the 10K, or supplemental filings. All right, so let's start off with number 1. Metric number 1 is free cash flow. Free cash flow is king. It tells you how much real cash the company has after running the business and investing to maintain that business. Why does free cash flow matter so much? Cash funds dividends, cash funds buybacks, cash funds acquisitions. Cash keeps the business alive when revenue slows. Companies can manipulate their earnings. They can't manipulate the free cash flow. Now, where you're going to look is cash from operations and capital expenditures, which are both in the cash flow statement or the 10Q or the 10K. Subtract them and you get free cash flow. If earnings look great, but free cash flow is weak or negative, that's a major red flag. Metric number 2 is you want to look at gross margin trend for the business. Gross margin tracks how efficiently a company turns revenue into profit before overhead. Why this matters so much: it shows pricing power, it shows competitive strength, it reveals if demand is softening as well. The trend is what matters the most ultimately. Gross margins are rising, company is strengthening. Gross margins are falling, pricing pressure, competition, or cost issues. And where you're going to find it is gross profit and revenue are in the income statement of the 10Q. A company that grows revenue but loses margin is running an uphill battle. And basically that gross margin is the percent of the total revenue which they are netting. So basically what the business is profiting, and that will be the gross margin. Metric number 3 is you want to look at stock-based compensation as a percentage of revenue. SBC, the shares companies hand out to employees. Why this matters: SBC increases share count. More shares, more dilution in the earnings. And when they dilute earnings, your piece of the company gets smaller. SBC as a percentage of revenue tells you how reliant a company is on paying employees with stock instead of cash. And where you can find the SBC is listed in the cash flow statement under operating adjustments. Revenue is at the top of the income statement. SaaS companies are notable for a high SBC. Some run 20 to 30% of revenue, which is massive dilution to the earnings. And if you see SBC percent is rising every quarter, that is not good. Shareholders of the company are basically being diluted. Metric number 4, you want to look at customer count, especially for a subscription-based business. Customer count tells the real story about demand. Revenue can grow even while customer count stagnates, though price increases. Revenue can grow even though customer count is stagnating through price increases. But a growing customer base tells you customer acquisition is working for the business, market demand is expanding, and churn is under control. And where you can find this, usually in the earnings press release or supplemental metrics, also sometimes called active users, paid customers, or enterprise accounts. You want to look for a steady, consistent uptrend. Metric number 5, RPO, remaining performance obligations. This one is especially important for the SaaS company. It's arguably the most predictive metric in the entire earnings report. RPO shows how much revenue the company has signed with customers but hasn't recognized it quite yet. In plain English, it's future revenue already locked in. And why it matters: smooths out quarter-to-quarter volatility, shows long-term customer commitment, and is a leading indicator of future revenue growth. And where you're going to find this metric is typically in the earnings release, near the top or the bottom. Also in the management discussion and analysis, which is a super important part of the earnings report. Also in the management discussion and analysis, MD&A section of the 10Q. If you start to see RPO growth slow, revenue growth will follow. All right, so what's the most important number? It depends on the business model, of course. For tech and SaaS, you want to look for the RPO and look at stock-based compensation percentage of revenue as being the most important. For consumer products or manufacturing, gross margin trends tell you everything about the business. And for mature cash generative companies, free cash flow is the single most important metric to follow. But if I had to pick one that works for every industry, it is free cash flow. Because earnings can be engineered, revenue can grow while margins collapse. Free cash SBC can make profitability look better than it actually is. But in the end, cash is the truth. And that wraps up the video. In your next earnings report, don't just look at the company beat expectation, beat revenue, beat EPS. You want to look under the hood. You want to look at these 5 numbers instead. You also want to look at the trends of these numbers. These will definitely tell you how the business is getting stronger or if the business is getting weaker. But thanks for watching. This is Stock Brock. Peace.